Welcome to the Property Profits Real Estate Podcast, the show where real estate investors talk strategy, capital, deals, and growth with your host, Dave Dubeau.
Well, I've interviewed a lot of folks over the years, a lot of multifamily syndicators. Haven't interviewed very many that can claim that they are an Inc. 5,000 fastest growing company winner. Well, today's guest, Feras Moussa, can claim exactly that. Feras and his company, which I love the name of your company, Disrupt Equity, have done close to or over $1 billion worth of real estate transactions. They focus on multifamily. They're based in Houston, and they are an award-winning company. So, Feras, welcome to the show. Great to have you.
Hey, David. Thanks for having me. Excited to be here.
So give us a little snapshot of you and the company, Disrupt. Where are you guys at as of the middle of 2026?
Yeah. So, for those listeners, right, the name Disrupt, like I said, it kind of got a tech spin. I came from out of the tech world, really. I was a former program manager at Microsoft, had a software company, and ultimately just realized, hey, there's opportunity in modernizing old industries like real estate. And so that's where Disrupt Equity was born. And thankfully, we've had a pretty good decade so far, right? We're coming up on, I think, 9 years or so. And
Nice.
To your point, it's been a very interesting 9 years, right? We've all seen kind of real estate really kind of take off really around the time we started, kind of top out around 21, 22, and have to work through 23, 24. And so, as a company, we're probably the strongest we've ever been, right? There's a lot of great people out there to hire. And so we've been just hiring on people that I don't even know how we can afford, but we'll figure that out with really, gearing up. And to your point, where we are right now, in 26, right? A lot of deals, maturities are coming up. It's been really tough for anybody in multifamily. Anyone that says it's been roses is lying, right? And for us, we just see that as the opportunity. And so we've been just kind of gearing up operationally. We have our management company in-house, as well as just gearing up with the acquisition team. And, we just think the next 2 years is probably going to be one of the better buying opportunities in a while. And we're seeing some amazing discounts, motivated sellers, people that have to transact. And so we're hyper focusing on how do we start to take advantage of that for us and our investors.
So what market or markets do you guys focus on primarily?
Yeah, so we're in all the major markets in Texas. So, based in Houston, Houston's home base, and Texas is obviously home base. And Atlanta is kind of the other market we scaled in quite a bit. And so we have a one-off deal in Florida, not as focused in Florida. We just can't get the pricing to work. But really, Atlanta and Texas are our hot bets.
Okay. And at this point, approximately how many different communities are you guys involved in?
Probably a little north of 20.
20.
Most of our properties, for the listeners who don't know, we're talking 200, 300, 400 unit apartment complexes. So our biggest deal that we have is a 530 unit. Our smallest deal is probably, what is our smallest deal? Maybe 180 unit right now. So.
Okay. All right. Large properties. And do you guys take these down by yourselves? Do you work with a group of co-GPs? How do things typically work that way?
Yeah, good question. So for those that don't know, right, what we do is we call syndicate equity. So what does that mean, right? I know a lot of your listeners may have never done a syndication. And if someone, let's say you have $100,000, right, of cash, that $100,000 lets you go buy maybe one house, maybe two houses, right? If you're buying a $300,000, $400,000, or $100,000 house, and that's it, right? Your investment is tied to one house. You lever up 75%. You bring your 100,000. You bought one house. If that house is vacant, great. You're making $0. If it's occupied, you're making something. Instead, what we do is I go find maybe 20 people that have $100,000, right?
Yeah.
That allows me to go put down $2 million. Then with $2 million, I can buy an $8 million property, right? And so we pull the money together into a bigger property. And with an $8 million property, we now have, maybe 100 units, right? And those 100 units are mix of occupancy and vacancy, and you have a fully dedicated team and on-site staff. So ultimately, to answer your question, yeah, we syndicate the equity, right? We raise the money with our investors, and we typically co-invest in our deals as well, from the company side, showing, hey, we're aligned, you skin in the game, and go from there. And then occasionally,
but you guys are typically the lead sponsor, the only ones involved, plus your investors. Is that correct?
We'll have co-GPs, right? But historically, we are the lead sponsor. Those ultimately, we want the success and failure to ride on us as a company, right? We have the management in-house, we have the team in-house. Disrupt's roughly 230 people, right? So it's about really, hey, the buck stops with us, good, bad, and ugly. And that's kind of the way we like it. The deals where we weren't the lead, those are the ones that have had the most issues. So we've kind of been, hey, let's take it on by the reins and continue to lead. So
All right. Well, that's a huge team. So you've been going for about 10 years now. What what have been your biggest takeaways from this recent kind of market upheaval? Like what really sucked for you guys and what did it kind of you mentioned it's kind of made you tougher. It's made you it's tightened things up for it. So what have you taken away from this whole experience?
Yeah, it's seeing the full cycle play out, right? And for us, I just feel like I have a new superpower in terms of just knowing how to negotiate with lenders, right? You're either part
Oh,
of the problem, part of the solution. A lot of people are just part of the problem. They put their hands up, they give up, they walk away from deals. Investors lose all their money. Lenders have to
yeah.
foreclose. All that. It's all terrible, right? And instead, it's really about, hey, how do you structure something that makes sense, right? We've bought a lot of deals in floating rate debt. And thankfully, the deals, whenever we bought them, we went in, we bought tight caps, right? We had longer term situations and we had reserves. And so that's helped us navigate kind of the spike in interest rates. A lot of people didn't have that. And for us, I mean, the biggest pain has just been Austin, right? Rents have fallen so much in Austin, and
Mm.
it's a big macro problem. But again, even in those deals, you build something out that makes sense for you and your investors and the lender, right? And you continue to work it out. And so that's been the new thing, is really learning how to get a lender to agree to restructure a deal for something that makes sense for the long run, right? Like, we know it's not a good time to sell. And so you don't
Mhm.
want to have to sell. And the deals that we're looking at buying right now are those motivated sellers that have to sell. They didn't structure anything with a lender. They didn't have the reserves. And, we're looking at deals that buying 50% of the cost of what the previous person bought it for. I mean, those are out there. Those are true pricing, discounts that we're seeing now.
Yeah, I've heard that from a few different operators for sure. So what's your crystal ball telling you about where things are going to go over the next year or two, especially in Texas and Atlanta?
Yeah, I mean, for us, we just think the next 24 months are going to be pivotal. I mean, we're seeing deals that are heavily discounted, very few buyers. And
Mhm.
so that's the opportunity. We're getting the call from the broker saying, hey, I got one offer. Come offer on this deal and you'll get it discounted. So for us, it's trying to curb the investor sentiment, because a lot of investors, it's the phrase you hear from Warren Buffett: whenever you want to be greedy when others are fearful, right? When there's
Yeah.
blood on the streets, that's the time to buy. And so we're starting to see that stuff where, we're buying stuff 60 a door with average rent in place of 1,000. I mean, there's so much
Wow.
margin there, right? And again, yes, it's gonna be a little ugly. Yes, it's gonna be some TLC, but that's where we've excelled as a company, right? Most of our biggest wins have been those value add deals where we've had to
Yeah.
clean up and reposition the property, and that's what we have the management company for. So,
So Ferris, speaking of investor sentiment, yeah, everybody seems to do the wrong thing at the wrong time. Like
uh-huh.
it's just it's crazy, but that's human nature. Um, what are you guys doing differently, if anything, when it comes to investor lead gen, investor relations, raising capital? Has that changed for you at all over the last few years, or are you guys still kind of going strong the way
Yeah,
it used to be?
no, it ebbs and flows, right? I mean, you
Yeah.
constantly have to rethink it. I think that's what one of our abilities to grow early on was: we did things differently than all of our peers, right? And now, it's almost like I was literally saying this earlier today to the team, which is, hey, all the our peers have caught up and they do what we do, but now how do we rethink what we're doing and reimagine it? So, with investors, right, in tough times, it's a time to communicate, right? It's a thing we do better and we want to continue to improve on, right? It's how do you communicate better with investors on what's going on, even the deal that we're looking at buying? Like, how do we start to really showcase and give investors a lot more behind the scenes as to, like, hey, here's why this is a good opportunity. And so
Hmm.
I think that's one place that, you know, we we have changed over the years, right? And how do we better communicate, spend more time with our investors? I mean, I was in Dallas last week. We host these investor dinners and just making sure we get around the country and they meet not with just someone on the investor relations team, but with myself and my partner, right? The managing partners of the company. And, and we just have a good conversation. What's going well, what's not going well in the markets. And so I think that's really, it goes back to what I said earlier, which is an educated investor is a good investor. So the
Right.
more we can educate them, the more they can understand, hey, real estate is cyclical. Time in the deal is better than timing the deal, right? And it's
Mhm.
about finding opportunities, and the best opportunity you can find at a given moment in time, structure it accordingly, and work it from there. So
What typically is your exit strategy with your properties, Ferris?
yeah, so for us, I like to tell investors we are opportunistic. We go into a deal saying, hey, this is a 5 to 7 year hold. But I'll be honest with you, we've sold a lot of deals in year 2, 3, 4, right? So, but we've also have deals that hey, this is just, we did a refi, we took money out, and we're in it for another 5 more years after the refi. And so we go in with a plan of how do we kind of stay in the deal if it need to, but ultimately it's all market driven. So if we get the right pricing, we're not the kind of guys that are going to say, hey, we said we're going to be in this deal for 6 years and we're only at year 4, like we're not going to sell, right? That's not us. I mean, we make money for our investors whenever we exit. And so it's about how do you get more wins on the table, because then the investor will take that money, invest back in with you in the next 2 deals instead of the one, because now you just made the money and grow from there. So a lot of our growth has been tied to investors reinvesting and bringing their friends.
Right. Right. So these days, a lot of people are going from the syndication model to a fund or fund of funds type model. What are your thoughts around that?
Yeah. My belief, and we've experienced this, is that ultimate investors, even if they don't know the market or the asset or the underwriting, they still want to believe and think they do, right?
Hmm.
And so we've done funds where it's kind of like a blind fund. They don't know what we're going to buy. We just say, hey, we're looking for this kind of property in these markets, et cetera. But investors want, for my experience, to be able to say, hey, I like Houston. Hey, I like Austin. Hey, I
Yeah.
don't like Dallas. I want newer properties. I want older properties. I want, suburbs. I want core plus, right? Everybody has their own flavor. And investors want to be able to have that ability to choose, versus if we did a fund, that power ends up staying in our hands. And ultimately, I tell people, in the end, you're betting on the horse, the jockey, much more than you are the horse. And so
Hmm.
yes, we can present a deal, and I've seen bad operators take good deals and mess them up, and I've seen good operators take mediocre deals and get them to succeed. And so
Hmm.
in the end of the day, even though as an investor they want to be able to choose their investment type, what I've learned is, that's a fallacy that most investors have. And that's fine, right? That's why we've done single asset syndications, or if we've done a fund, it's already predetermined assets. But again, it's one of those things that I think investors almost use that as their primary focus, versus like, no, understand who you're investing with and what the rules of the game are for them. So
Yeah. Okay. Well, words of wisdom from experience there. I was thinking back to the beginning of our conversation today, Ferris, and you mentioned that you come from a tech background. You had a software company, I believe you said. You worked with Microsoft, was it? Or
yeah, I was a program manager at Microsoft previously.
yeah, okay. So you come from that whole tech background into an older, clunky kind of industry, real estate. What did you bring from tech to your real estate company?
It's the focus on tool system processes,
Yeah.
right? Like most people don't realize, like most software companies, their asset is their people, right? With real estate, that's not really the mindset. People think the asset is the property. And it
Hmm.
goes back to what I said, you're betting on the jockey, not the horse. So even, so investors are betting on the jockey, which would be the operator, which is us in this example, right, to succeed. But then us in turn, we are betting on our jockey, which is our team, our staff. And you have to have a real focus on how do you build a culture that aligns with that, that believes in that, and everybody, has that same grander vision, right? Where it's not just check in and check out of a paycheck, right? Which again, it's hard, right?
Yeah.
The district equity side of the business is the easier side. We have, awesome people, much more tenured, been with us for a while. Whereas on the management side, it's a harder kind of business. And so how do you get more of that type of culture into a management company where they don't feel like it's a satellite, it's a company with 20 satellite offices, because that's how management companies are. There's a bunch of
Right.
distributed offices, and
Everybody's all over the place.
you have a manager that's making anywhere from 70 to 100,000 that is making the decisions for a multi-million dollar asset. That's tough. So how do you change that dynamic?
So how do you?
Oh, I
Like,
mean,
what have you?
that's where it's bringing a lot of the things that are more the norm in tech, right? Around how do you pay people well? How do you give them career growth? How do you even do things as asinine as performance reviews, where you can have the time to have a dialogue and saying, hey, here's what's going well, here's what's not going well, and how do we get you to grow to the next stage in your career, right? And, even simple things like showing up at properties, bringing desserts, right? Taking people out to go do morale events, forcing managers to do both tenant retention events and employee retention events, right?
Mm.
How do you centralize those things to make sure they're happening? Because a property is really busy, so people end up getting lost just in the day to day, versus how do you get people to pause and do some of these other things that, again, those are very common in tech companies, not as common in other companies. And so, and then maybe the last thing I'll add too is just getting a renewed focus on KPI and deliverables, right? It's not like, hey, Dave, can you do this for me? It's like, hey, can you do this for me by this date? And here's how I define it, success. That changes the conversation, changes the expectation, helps you succeed, it helps me get aligned, and it's a win-win for everybody.
Excellent advice. Well, hey, I can tell you brought a lot of valuable stuff over from tech into real estate.
Yeah.
That probably explains all its growth over the last 9 years. That's for sure. Congratulations. So, Feras, I'm sure there's going to be some folks here interested in finding out more, connecting with you. How should they do that?
Yeah, I'd say check out our website, disruptequity.com, DISRUPT equity.com.
Very good. Well, Feras, this has been great. Thank you very much for being on the show.
No problem. Thank you for having me.
All right, everybody, take care, and we will see you on the next one.
Thanks for listening to the Property Profits Podcast. If you'd like to be a guest on the show, apply at daveinterviews.com.